Alright, so we have a 5-minute chart on the left-hand side. That's the US 500. And if you look at the ES chart on the right-hand side, and again, this is a 5-minute chart, we'll drop down to one in respective lower time frame if there's a necessity for it, but right now there isn't. The opening price Sunday for ES came in at 4105.00, and the closing price on Friday came in at 4099.50. The difference, it's a gap higher. So this is new week opening gap rather. And the midpoint between those two price points is this heavy dashed red line. You can see we came down to that beautifully so far this morning, showing a willingness to want to respect that level. So everything so far is delivered as I teach it. I'm watching this volume imbalance in here, and I'm also watching the buy side liquidity resting above the high here on ES. Now, apart from the new week opening gap levels on the chart and a few things I've added from the daily, I'm going to try to keep the chart clean as I can. Now be mindful that where ES is trading right now, it's higher than Friday's close. So there's a premium in respect to the opening price versus where we closed on Friday. So what I mean by that is this. See that gap? So we're gapping up here when it closed down here. So it's usually going to create some kind of a draw down into the price action. The levels I like first is the high on Friday's session. Then all the wicks in here, study that. There really isn't any inefficiency in here on the 5-minute chart. So if we drop down to a 1-minute chart, I know you want me to be busy with that US 500 chart to the left, but we're really early in the session and there's nothing here that I want to participate in yet, or would want to participate in. So here's that gap, and we want to see it, likely try to draw into that. Doesn't mean it will, but that's the first expectation when we look at the opening. So we're watching the opening range. As a reminder, tomorrow is CPI, so my expectations today are rather low. But I'll try to work out a range, and you can observe it real time. Maybe get a 5-handle run. You can study that live before the close of this morning session. Now that 4111 or 4111 line that you're seeing here on the right-hand side chart, what that is the consequent encroachment of the daily candle from February 7th, 2023. The wick, the lower wick on the bottom of the candle, that level is what's being annotated right there. And just above that, should we get some kind of a, see now I like this right here, this looks like it's failing. And reach down here to the lower end of the gap. Do not take any of this as trade advice, please. All you're doing is tape reading. You're observing, trying to get a feel for what the market's likely to do. There's liquidity resting at the 4102.25 level. That's in the form of sell side. We have relative equal lows here, here, and here. Now I'll drop down on the 1-minute chart on the US 500 chart on the left-hand side. So if you look at the high here, it formed down to the midpoint of the new week opening gap. That is consequent encroachment. So what I like to look for is a price run that moves higher, that can be faded, or I expect to see it fail, or maybe create a sell signal, something to that effect. And if we can get through, and there's nothing saying it's going to do it yet, but if it gets below the consequent encroachment level of 4102.25, if it breaks through that, that becomes, in my mind, a fulcrum point. And then if it trades down to the low end of the new week opening gap, which was Friday's closing price, if it can trade through that, we would look for the first objective on the downside would be 4098.50, and any further animation to the downside would be 4094.75. And frankly, that would be as far as I would expect the morning session to move. Simply because, not to say it couldn't move, and not to say it's going to go down there either, because it could go and run up here and take out 4110. I have nothing in here that I like. All you're doing is observing. With the expectation the CPI is going to be the big monster move for the week. That's the reason why caution's advised here today. And not try to get all of what you were hoping to make for the week all inside this one day. The 4087.6 level and 4083.9 level. That would be my expectations. It should be break below and get animated below the low here at 4091.2 on the US 500. This is what that chart is over here on the left hand side. Okay, returning back into the high end of the new week opening gap. So far, nothing really stands out with the relationship between the NASDAQ and the ES at the lows of the day so far after 9:30's opening. So no SMT divergence there. So I don't see any reason for it to draw our attention to NQ. And since I'm primarily showing you one instrument throughout this year, I'm teaching you to be a specialist, number one, so that way you're not jumping around, because all the price action you would ever need can be found in one asset. Okay, nice run away from that 4102.25 level. All of this is the opening range. So the first 15 to 30 minutes, there shouldn't be a whole lot of emphasis placed on any of that. When we get into the 10 o'clock hour, usually there's algorithms that start running in that time frame, usually 9:50 to 10:10, and we'll look at what buy side or sell side liquidity and any inefficiencies that reside at that time. Right now, all we're doing is trying to get a feel for what it wants to do, and too early to tell really with high probability. So we had a run pre-market for 9:30. Made an attempt to get down to Friday's close after opening at 9:30. Found some support at the consequent encroachment of the new week opening gap. Buy side now is in the crosshairs. Now, what I'm interested in seeing is how we trade. Should we take out the high at 727 candle? So if it runs through that buy side, how do we deliver after that? On your 15-minute time frame, the February 9th, 2023, 12:30 or 12:30 candle, there is a sell side balance, buy side efficiency. You want to extend that to the right. If we run through with a lot more momentum on the upside through 4116, we could see 4122.5. But if we get above that 4115, reject that and start to break down, then I would look for it to try to return back to Friday's closing price. Because all of this right here could be just the Judas swing for the morning. What makes me extremely cautious and not have any strong convictions on where I think it's going to go is because we have CPI tomorrow. So far, NASDAQ's basically on par with the highs as well. So nothing's really standing out as an obvious run here. Still 50-50. Now I would like to see it rip higher, only because we came back down into this breaker here. This is this up close candle. We came into it, also traded inside and completely repriced to the low of this buy side and bounce sell side efficiency. So 41.18, that'd be a nice reach above for that buy side. But anything just piercing through this is enough. Now US 500, if you notice that, it's already done it on the left-hand side, but futures have yet to do it. And what you're doing while watching price with me like this is you want to train your eye to, number one, look for runs that make sense to you. What pattern from the content that I teach, which one do you trust more? Or which one are you able to see as clearly as possible watching a small time frame like this? But don't think that it only works on these lower time frames, because everything I'm showing you with these candles on a 1 minute basis is absolutely the same thing if you were looking at an hourly chart or a 4-hour chart or a daily chart. It just requires a lot more time for that candle to complete and close and start a new one. And obviously the ranges would be much larger, which for some of you is probably what you're looking for. You want big runs, you want high R multiples. You can use the lower time frame entries and trade with the higher time frame PD arrays and get these extrapolated returns versus the small, minute theoretical risk. And it looks like it's just crouching right below that buy side liquidity pool at 41.15. Like I said, US 500 on the left-hand side. That's what that chart is. It has already whipped through it and tapped into its buy side. ES on the right-hand side has yet to do it. So since we had this run here, that is your bullish breaker. That traded down into a buy side and balance sell side inefficiency. So buy side's about ready to get ripped through. Watch this wick right here. I'm watching the midpoint of that with consequent encroachment. We've already tapped it here, so I want to see it expand through. There you go, like that. I'd like to see it print 41.18. Now the same thing I did with the downside objectives. We're using the fib for like targeting. What you're looking for is price runs that have retracements and a buy side liquidity above where market price is. If you're looking for bullish runs higher, how far can we go? That's one of the things that I was trying to teach last week. Can you see this high here? We're using it with that low, and if we went below this low here, yes, we wick through it, but did it really trade through it and show limits to go lower? No, it only just tap through it for the sell side. If it's a fulcrum point, it's going to run right through it. Like this high here now becomes a fulcrum point from this low. So from that low up to that high there, you can see why I was looking for 41.18. And it's just simply me looking at it for years, seeing that range, and I'm multiplying it between that low to that high. What's one standard deviation of the same range higher from this high here? If this high is broken to the upside, and we come back down into a bullish breaker, what makes this a bullish breaker? This up close candle here. We have a low, the high, and low low. Why am I not using the wicks? Because they're gaps. I'm taking you right back into the price action. That is what? Showing you the bodies. The bodies tell you the story. The wicks is where the damage is done. So I'm cutting through candles to take you to the narrative of what should be expected in price action. Even on a sloppy morning like it is here, it still will talk to you. I don't have the 41.18 delivered yet. They may not do so. And it would not be a terrible, upsetting thing for me because, like I mentioned when we first started this stream, my expectations are very, very low because of the volatility that's expected tomorrow. I'm looking at the NASDAQ at the highs. So far, they look like they confirm that. Run up in there. So these higher highs that's formed on ES here on the right hand side, it looks like NASDAQ has supported that run. So nothing in terms of distribution really if we're looking at S&T. Now watch that volume imbalance here on both the US 500. Let's see if we can get that 41.18. Now we're above that volume imbalance. pardon me. Do we get a touch of that volume imbalance again and then send it to 41.18? Watch that. Or does it rip right through 41.18 and go into that 15-minute imbalance I mentioned? I would have liked to see that candle come down, touch the volume imbalance. That would have been nice to see that before taking out this high. And then rip into 41.18, 41.21 and a half. I wouldn't want to see it now. And why am I saying that? Because we've already started the run and we went above the bodies of these candles. So now I consider this series of 2 down closed candles as a bullish order block. I want to see it support price around here. You can come back to this candle's high, but I'd like to see that stay open now. See that? You can see that right there, stay open. It can touch the opening of that candle and then rip into 41.18, 41.21 and a half, and then on your 15-minute ES chart, you want to have 41.33.75 noted as well. That's the high end of the 15-minute fair value gap, which is a SIBI. I'll show you on the chart in a minute. I'm just looking at other charts because there's a 41.18. It's the 15-minute candle at February 9th, 2023 at 12:30. The time interval for there. So if you look at the 15-minute time frame, so if you're looking too close and you have your candles so drilled in, you won't be able to see this or appreciate the levels that it's going to likely reach into. So we're going to drop in that 15-minute fair value gap, which is constant encouragement. So 41.28 even. Have that annotated on your chart as well. So we're going to look at 41.25.25 and 41.28.25. If we were to get a blow off move to the upside, this fair value gap on the high end here, 41.33.75, that would be my morning session high objective. Should it reach that, I'd be content to move to the sidelines. So you have 41.18.6 for your consequent encouragement with the fair value gap on US 500. So just make sure you have that measure on your chart for those that are following along on the CFD on the right hand side. So you can see how watching in the morning using the opening range, not rushing, not trying to get in there and make a decision right away. These types of price runs, they're not essential for you to be a part of, especially while you're learning. And then -3 standard deviations at 41.34.5, which is outside the spectrum of the February 9th fair value gap. So I'm not really interested in that one because that's, in my opinion, a little overzealous for today. If we can hit consequent encouragement, that's satisfying for me for the morning session. Now looking at the run from 950 right in here. So the market trades back into an order block, and 950 to 1010, that's a macro, is likely to do what? We were looking for a price to reach into 41.18, 41.21 and a half, and then also into this 15-minute fair value gap. Does price support it here? That's what I'm watching at the low end of that 15-minute fair value gap. Watch this little inefficiency in here. When price cleans up a little bit more, and it will, you'll see how fun and precise things are. It just becomes really, really easy to see the setup. They can't hide it. Not that they're really trying to hide it here. I don't want you to read too much into it when I say that. It's just hard to ferret out the really low risk, high probability setups in environments like this because you can get a lot of chop, retracements, a lot more movement against your position entries than you would like to see in like easier market conditions, which you'll understand later in the year. By contrast, days like this versus days where you see the outline move, where it should move, where it shouldn't move, and it just takes off, runs. Real nice and sharp, no real deep retracements, almost like immediately in the money. That's a low resistance liquidity run signature. So that's really what I'm trying to teach you this year. But we have to work in every individual daily range to fully appreciate what it is that makes a low resistance liquidity run. So what I just did here was we had a retracement down into a fair value gap. What kind of fair value gap is this? Buy side imbalance, sell side inefficiency. Up close candles that create a fair value gap is a BISI, B-I-S-I, buy side imbalance, sell side inefficiency. We had the sell side offered here on this candle. This candle's high comes in at 4120.50. This candle here, its low comes in at 4120.25, 1/4 of a point, one tick outside the fair value gap. That's permissible, that's reasonable, it's not upsetting anything, but that's also the signatures of a day like this, where I mentioned before, the precision is going to be slightly skewed because tomorrow is the real event. That's the real event, that's the thing everybody's waiting for, so it's going to be a little bit less perfect on a day like this. Much like the reasons why I try to justify why I don't trade on the Thursday and Friday of non-farm payroll. Because it's like this, where it can be just a little bit outside the lines that I like to see it color inside of. But what I'm showing you here is, should we run higher and take out the high, look what they left. And that can be, so we have relative equal highs here. To me, I view that as engineering liquidity. And don't be surprised if they take it below this low now, because that'll sell the idea that this is a top or a resistance level. And if we take it below this low here and we trace down into this fair value gap here, look at all the back and forth in here. See all that? That to me is a balanced price range. So, meaning, as much as I'd like to see this stay open and act as a breakaway gap, if I was bullish, I have no position on right now. But I'm making the case for arguing if I was already long down here, I'd want to see this left open, do all of the reaccumulation of new longs here, and send it above these highs. But I'm willing to accept the fact that because they've now priced in a relative equal high, these two highs being basically the same, if they take the short-term low out here, then it can come back into here, which is, again, one of the reasons why I teach not to trail your stop loss up, because you don't know when these fair value gaps are going to form. You're too new. You have no idea when they're going to form. I usually have a pretty good idea of where they're at, because I'm familiar with the range I'm trading in, and because of signatures like I taught last week and the week before, where using the PD array matrix when it's in a premium to a discount, just like there's a threshold when you don't want to add new pyramid entries, there's also a threshold that you want to see price move beyond before you consider moving your stop loss up. And I'll cover that this year, don't worry, but we're not even in the entry points yet. Right now you're just trying to read price, because if you don't know where it's going to go or where it's going to try to gravitate to, it doesn't matter what your entry strategy is going to be, it's going to be probably wrong. But if we can trade above these relative equal highs, we have a standard deviation negative 0.5, which is just short of consequent encroachment, this level here. So at 4127.50 and then 4129.75. So let's assume that it does find its way up to this level, midpoint of the 15-minute gap on February 9th. This would be my objective for the morning session, and I'd be content. If it goes through it and expands, we always have the probabilities of it reaching to the high end, but I don't believe that's something that we should look for this morning. I could be proven wrong. But if it goes through consequent encroachment, it could go to this level here. In your mind, you should see these relative equal highs here as a buy-side liquidity pool. Now we took out that short-term low. So anyone that's being short or going short, they now have their stop loss right above here. What kind of stop loss? Buy stops. Which is why I write buy-side liquidity. Okay, so we want to keep this fair value gap annotated. Just extend it forward. And in here, why do you sometimes use lines and sometimes you use the rectangles? When it's in close proximity to one another like this, it helps me keep my frame of mind when I'm teaching you. But I mentioned if we take out that short-term low here, we can dip down inside this fair value gap. So far, we're seeing institutional overflow entry drill, which is a partial entry into a gap, which is a fair value gap here between this candle's high, this candle's low. What kind of gap specifically is this? A buy side imbalance, sell side inefficiency. Buy side was offered, It's inefficient in what? Sell side. But if it's bullish and they're going to run on retail that are, in my opinion, being introduced to a potential shorting opportunity for them, and they trust when they see these types of things here, that double top type thing. It looks like the textbook version of what? Resistance. And if they drop it down below a short-term low, what do they see that as? That's a market structure shift, or it's a break in market structure. And that may be true. It might happen here. But I like to look for periods where there's an arm wrestling match between these two categories of traders. Yes, this is reasonable if the trade back down in here. It didn't even go to the midpoint of this fair value gap, which would be consequent encouragement because it's a gap, not a candle or order block. If it was an order block, it would be mean threshold. But because it's being identified as an imbalance, we didn't even trade down to the midpoint of that. So let me show you what I mean by this. Between this candle's high and that candle's low, we have a price point level of 4118.75. So we didn't get down to that level here on this candle. This candle's low comes in at 4119 even. So it's 1/4 of a point higher than that of the midpoint of the gap, which is 4118.75. Because it didn't go around midpoint, this is viewed as institutional order flow entry drill. I know it's a mouthful, but it just means that if you're bullish, if you think prices are likely to go higher, I'm not suggesting that you should be long, but if you are expecting prices to move higher and you see a fair value gap, and you want to see a level of imbalance like this stay open, which would be the argument if you were bullish. Okay, if you're bullish, you want to see it try to reach up in the consequent encouragement, because we have time. Look what time it is still. In New York time, that's what your chart should always be on TradingView. It's 10:16. So we have a little bit of time left still, and it can expand up into, to take the buy side out, up to it, through it, and maybe hit consequent encouragement. And that will be a wrap for the morning session, and I would consider this a profitable endeavor over charts. But because we only came down partially in here, the idea of leaving some of this open, and I don't recall now because I've been looking at this chart on the left-hand side and going back and forth and trying to keep my thoughts collected as I describe what it is I'm looking for. I don't recall, but I think I did, and you can correct me if I didn't. I believe I said I want to see this fair value gap left open before we see this traded through and maybe even hit the consequent encouragement. If I didn't say that, just know that I would have liked to have said that, because that's what I would expect. But I think I did say something to that effect. But again, you can go back and listen to the recording. So I mentioned this, how I'd like to see this as a breakaway gap. So now I know I said it because I want to see that stay open. Breakaway gap is just like a signature where we can see price really snapping higher and having no real immediate interest to come back in to reprice over top of all of this. That's sometimes very indicative of seeing higher prices. But because we've met a 15-minute premium array in the form of that fair value gap, we've dug into what? Did we meet the lower quarter of that? Just fell short of the quarter level of that fair value gap on the 15-minute time frame. We keep coming back into this fair value gap. The fact that it's doing what it's doing right here is also another reason why I'm teaching and preaching to you caution on a day prior to like news events like non-farm payroll, FOMC, and like tomorrow's CPI number. This type of price action is a classic delivery in price, where it's just a lot of hurry up, move something, move somewhere, and then chop around a little bit and drive you nuts. Because you just want to get out of the trade. You just want to get the trade to go to your target, be done, and be over with. Unfortunately, when you're trading ahead of high-impact news drivers like CPI number tomorrow, non-farm payroll, FOMC, something to that effect, you'll get trading conditions like this, which makes it high resistance. So high resistance liquidity runs, we're looking for a run into the imbalance midpoint at 41.28 even. That's my objective for the morning. Should have hit that, I'm going to do moves like Jagger in front of my wife, and she's going to be like, whatever, you didn't take the trade. But for learning purposes, you'll see that this is what it's like to be delivering in high resistance liquidity run signatures, or conditions, not signatures, where it's really, really frustrating sometimes before it gets to your objectives. And another one would be how we failed just 1/4 of a point, one tick, before getting to the quarter level of that 15-minute fair value gap. On another day, it would have ripped right on through 41.28 even, and probably even climbed all the way through to the high end of it, being this height. Okay, but all of this right here is what you're going to endure if you force yourself to trade in conditions that are high resistance. High resistance doesn't mean like support resistance. It means it's resisting clean price runs where they just run big ranges, speed, efficient run right to where you want it to go. That's how you want to trade. You want to trade in those conditions. But as a neophyte, someone new to trading and not really versed in price action, even if you are profitable in trading for a long time, it's probably something you really never paid attention to. There are times when the market gives you these very stagnant types of conditions where, yeah, if you have a really wide stop from your entry, don't ever really move it, and just endure through the entire session or the entire day, your targets may get hit. But because you're not sitting in front of the chart watching every individual minute candle, it will be very frustrating. And for a new student, what I do is I take them into the charts and show them, by contrast, this is a high resistance liquidity run condition. This is what we can expect and what you would endure, so that way they can feel what it feels like to be in that. Like, it's a lot of time. It's moving very, very lethargic in this small little range before taking out buy-side liquidity. Whereas you would have rather wanted to see what? It trade down to that blue rectangle and then volley higher, ripping through the buy side and touch 41.28 and then swing our checkered flag and we're all happy. That is not an immediate gratification in conditions like this. You get that type of immediate gratification, immediate feedback that you're on side, the right side of the marketplace, in low resistance liquidity runs, where it doesn't do a lot of this consolidation. It's in a hurry to get somewhere. It's in a hurry to get there quickly, and if you're on the right side of the marketplace in those conditions, it's very satisfying. There's nothing more satisfying than that. See how it just went up there and just got real close to the buy side, and then we're pulling back down to the low end of the fair value gap. This is the stuff you want to record in your journal. You don't want to say, this is so damn frustrating. You don't want to do that. But you do want to observe the length of time that it takes, and maybe ultimately a failure. It doesn't mean it's going to go, I don't know for certain if it's going to go above that 41.25 and clean that buy side out right now. They could leave it just like that, retrace, and then later on in the lunch hour, or on the other side of the lunch hour, wipe through that buy side liquidity. That's the problem that you're going to encounter trading in these environments, versus when the market's really obviously loaded up to go in one direction over another. It's one-sided is how I teach it. If you can justify the trade only in one direction, that is my ICT definition of high probability. And that high probability condition is what we refer to as salad days, easy day trading. Like easy, get in, get your money, go home. Whereas now, when you're in these types of environments, you're working for it. And at the end of these days, even when you're profitable, you feel like you've worked out. You feel like you're drained. You just want to take a nap, relax, and not even want to look at a chart because it's drained you. Because you're taking a lot of time and energy, and you're burning a lot of calories. Your brain's doing a lot of calculations, what if thinking. You're anxious. You're running all kinds of scenarios. What if I don't take my partial here? What if I don't roll my stop up here? And what if it comes against me and digs in and takes away 40% of my profit? How will I feel if I don't take my profit here? What happens if I do take my profit here? And it runs the buy side and goes all the way to the top of the fair value gap. That's what you're going to encounter, and you want to observe all that. That's the whole point of me sitting with you over top of these charts, because that is how you learn. Because you're going to discover a lot of things about yourself that you probably thought you were very strong. Your will was strong. You're very disciplined. You think you're disciplined. You think that you know what you're doing. But when you're forced in front of the charts like this, they are a mirror. And they're going to show you who you really are. They're going to show you all your imperfections. As wonderful as they are, that make you unique, you have to refine many of them as a trader and keep them from manifesting themselves in your charts or your trades. And that's not easy to do. And I'm not guaranteeing that I'm going to be successful for everyone in that regard, because all of you have your own individual personalities. And there's character flaws that all of us have. They may be viewed as a cute little quirky thing that your spouse or significant other likes about you. But in the markets, they will serve you your rear end. So you have to be mindful of that and understand that a weakness is not something that makes you a bad trader. It just means that you have something to improve upon. And you have to either develop coping skills for some things, which my coping skill that I needed right away when I first learned how to trade was the fear of getting in. Like, I needed to know that what I was using to get in the trade was worth even employing. I discovered I was over here. Sorry, I know some of you were mad at me. Can you just go over to the 1 minute chart so you can see what it's doing? You can see what the US 500 chart's doing on your end if you follow along on that. As long as you can see what the US futures market, the ES on the right hand side, is doing comparatively, you should be fine. Did I do this? No, I don't think I did. Buy size about to get spent. Now I want this one. Alright, so we have 4118.6 for US 500. See what ES is doing? See how it's just sitting there crouching below? This is the type of stuff that's going to drive you nuts in these environments. You're going to be like, oh, like the other day when I was in there and I was looking for 4101.50, that was my number, whatever it was. I called the high tick, but the difference between the bid and the ask, that's what we're looking for. See that? It feels like well, let me not use that word. It feels like a sweet release when you're in these trades and it finally gives that to you. You know what I mean by that. I'm not going to go there. And we still didn't deliver the 4128 level. This is, again, one of those classic frustrations. But you would have a screenshot of this, and this would be like a partial. And you would annotate in your chart. You want to record how much time you endured watching all of it come back down into levels that I outlined for you, that it should do certain things, certain classic characteristics that these PD arrays should do, and should they deliver in price. Notice how we came down to this down close candle here, right on that. Note also in your annotations how this candle went right down to the low end of the fair value gap. That's perfect. See that? So high resistance liquidity runs are not exempt of precision elements that I'm teaching you. It just means that you'll have a lot of this choppiness in between them. And sometimes they'll color outside the lines like it does here or here. And that's fine, because I taught last week. It's like when you're cutting the grass. Remember I was giving you that analogy? When you're cutting the grass, gentlemen, you cut through, and you turn the mower around, and you go overlap what you've already cut and what is uncut. It's that way you're making sure there's no seams in the lawn, no little mohawks where there's a little strip of grass that's still too high. That's what the market's doing here. It's overshooting the fair value gap, making sure there's no seam here. Down into this imbalance, overlaps it a little bit. That's what makes it institutional order flow. Because I mentioned I want to see this stay open before we get to here, and preferably into the consequent encouragement of 4128, then any dip down here should not be viewed. And this is very scary in your first learning. I understand. It's like most of the questions I get is, how do I know? Like, how do I know that to trust this not being a stop out? How do I know it's not going to go through that high and take my stop loss when I'm taking a short using the 2022 model that I taught on YouTube? The fact that you're walking through this with me live right now is going to answer that at the end of the year. So for some of you, before we even get through 3 months, you're going to know, oh, it makes sense now. It's experience, that's all. But because you're afraid to fail or you're lazy, you're not doing this. You're wanting to trade. You're pushing a demo account. You're trying to get funded. You're trying to do these funded account challenges. There's your 4128, so you want to screenshot that right there. And I'm going to tease the shit out of my wife later on. I did it again, honey. But the elements of what we're seeing here are not going to be this frustrating when we're in one-sided markets. And you're going to see the difference of this versus what we're looking at now, which still can deliver your trades. I'm not saying that you can't trade these, but it's really important to understand that you're going to work harder and you're going to be worrying more. What's the upper portion? I should have had a level on that. I apologize. Let's go back and add that now. So between consequent encouragement of the fair value gap on the 50-minute time frame on February 9th, your next objective for ES would be 41.31 even, and then there you go. For me personally, this would close my morning session. I would be done. I would close my trades. I would square everything, and I would relax the rest of the day. I'd watch some Netflix and chill, okay, or as we like to call it, chicken and fill in the blanks. Relax. Enjoy your time away from the charts. Don't force yourself to be looking at for another move because there's time left. Just simply because it's 10:30 and you have all the rest of today, don't look at that and think, I'm wasting my time by not being in these charts. No, you're pushing too hard. You might have an edge right now that I'm helping you hone. And when I tell you to stop, close the charts and walk away. If you don't do that, you know what you're missing out on? Developing discipline and patience and overcoming what? Fear of missing out. I don't care what it's going to do the rest of the day. I don't care. Because I know what I use and what I'm teaching all of you is going to repeat every single day. But I also know that there's going to be times where the markets are going to be really not favoring me to participate. And we've watched something pan out this morning. It's not about being right. Initially, if you look at what I gave last night or yesterday, I gave my pre-market analysis, what I was liking to see, or what I would have liked to see develop in price action. I mentioned that if we had a higher gap, if we gap higher, that means we're probably going to do what? We're going to go up into those imbalances that we're trading into right now. Go back and look at the pre-market analysis. It's not plan A, plan B, because I don't know which one's going to be really there when we open up on Sunday, and I don't know while I'm sleeping during the London session, Sunday night into Monday morning, my Monday morning. I don't know what it's going to deliver and what it's going to provide me. So when I woke up rather early this morning, I looked at it and I tweeted to you, I said, okay, I'm going to require 9:30's opening. But going back to my pre-market analysis, what was the filter? If we have a gap higher opening, I want to see it try to trade back down towards what? Friday's closing price. We tried. We got real close to it here. The low came in at 41.01 and a half, but it didn't get to 49 or 40.99 something, whatever it is. This level is here, 4099.50. So that's what I would have rather seen. When you heard me talking about it live, I said, let's just see if we can get down there. It didn't do it. What did it do? It ripped higher, took a run above this short-term high, and we outlined the buy-side imbalance here. We talked about the breaker here. We talked about how it's going to likely dig in and then finally reach up into the 41.18 level, which it did here. Then I said 41.21 and a half, which it did here. Then we're going to dig into that 15-minute fair value gap, which we did here. We're going to go to the quarter point. We failed to do it here until that candle there, and then get up into consequent encouragement, which is the objective I would have. But if you're holding on to a trade and not listening to me, your partial should be taken off here, and then maybe leave another one for this here. But I would not be trading over top of ICT talking over price action. You're going to get hurt one day when I do it wrong, and I don't want you to have that experience. I want you to just simply observe, listen to me. Each one of these are a laboratory experiment. They're teaching you how you're going to feel without any numbing, without any kind of right or wrong. Every time I'm talking to you like this, who's at risk of being wrong? I am. So it frees your mind of all of that concern. You're getting to watch me walk out here without a safety net. And I'm teaching you the very things that I've taught on that YouTube channel. I'm proving efficacy. I'm teaching you that these concepts absolutely work. I'm teaching you that there are periods when you're not going to know what the market's going to do, and that's okay. It's okay to have that moment but not knowing what it's going to do. Because if you sit around and wait for the market to tell you what it wants to do, it's like it is here. Even though this is high resistance conditions, it's still going to likely deliver to our levels, but you have to endure a whole lot more pausing, more retracements, stagnation in price action before it gets there. But here's your third quarter level, so that's been reached now. So it really should expand up and touch the top of that. I think that would be favorable. I'd like to see it happen, and I can close this and go through my moves like Jagger. It's an inside joke. Boom, hello. Screenshot that. That's what it feels like. That's exactly what this will feel like for you when you know what you're doing, why price is going to do what it's going to do, and you're done. You don't care if it rips all the way up to 41.50. You don't care. You just close up shop, annotate what you want to annotate right then and there, close your charts, walk away for about an hour. Let me go up to a 15-minute time frame. I'm not going to use anything with the US 500 anymore. I'm going to close this in a second. Just want to see where we're reaching for. Alright, there we go. So we have this, and now we have this is your next area for a premium. So 41.43, 41, 44 and a half, right in there. Everything beyond that, this is all balanced here. So there's only this small little inefficiency, and there's nothing of any interest until you get to buy side here. So just focus on that the rest of the day. That might be where we draw to. And if I was going to trade the afternoon session and say we haven't gone up there by then, and we haven't really fully erased everything we've put in this morning, this would be an afternoon session, last hour trading day objective for me. That's how I would treat that level. I'm not saying that that's what you should try to trade and do, but in your notes, have this in your charts, okay? And then annotate that and look and see if we have any reason for it to draw up there. And if we do, if there's nothing else beyond that that needs to be viewed as inefficient because it's been back and forth.